For the last AHA with Amplify of the season. We're so excited that school's ending, baseball season's ending. There's so many different endings right now, including our time with you at AHA with Amplify. We are going to take a break because we know you're going to be busy with your holidays and your golfing and your beaching and your lakes. And so for July and August, we will not have a webinar series. And then we hope to have you back in September when the school year starts. And what I always say is the actual new year for most of us. That's when AHA with Amplify begins again. So stay tuned and you'll hear more about what kind of sessions that we're going to hold for September, October, November, December. We also take a break because people are busy with their holiday season. And then the remainder of that season goes from January to June. We appreciate all of your attendance. We love learning with you. We love being able to give you certified professional development and the opportunity to meet some of our friends like CoPoint that we have here today. It's been great for Amplify. It's been great, I hope, for all the members. And we just want to give our sincere gratitude. It's humbling that I've been able to host so many of these. We started AHA with Amplify as a COVID initiative, and it has turned out to be a really, really great opportunity for us to have a member community, to learn with you, to have CPD with you, and again, provide a stage for our friends and business affiliates like today's CoPoint. So thank you so much for all the time that you put in, and make sure that you stay on the AHA with Amplify email list and pay attention to what's coming up next, which will be sent to you through that email as well as LinkedIn. I anticipate there'll be a fall live event as well, and live events do sell out pretty fast. We do have an intimate approach to them, so there's not that many seats. So stay tuned, pay attention, and if you have any ideas for presenters or topics, send them to us at any time. We're always looking for ideas. And maybe Joe will even send a survey to formally get those ideas from you. So without further ado, let's get started on the last AHA with Amplify of the season. SR&ED is a very important topic. It's a topic that I think sometimes we don't realize that it's applicable to us. And so I really do hope that some of you that are here might be thinking, I don't know if this is relevant. And wouldn't it be even better at the end, you realized it was, but you didn't want to do it. So then you call CoPoint to help you. The cool thing about getting professionals to help you with SR&ED is that a lot of times the compensation is in a manner that you can't really lose, right? So I love that as well. And certainly, unlike GST or other taxes, nobody cares if you apply for SR&ED. If you don't, you just don't get the money, and that's that. So nobody will follow up with you. Nobody will audit you. So I guess you can get away with it. But for most of us who are business leaders, business owners, or finance leaders, that would not be a great place to be. If we can get money back into our pocket, especially to do that research and development and to improve our products, services in our community, then why in the world wouldn't we put that money in our wallet and put it to great use? So I am thrilled. I do not know much about SR&ED, which I probably just proved in my intro. And so we will have lots of questions. Be sure to ask them at any time. We're going to interrupt these fellows with our questions throughout the presentation. And I'm excited. Let's get rolling.
Awesome. Thanks, Jamie. I think everyone should be able to see that now. We're sharing. And I think you nailed it. So you definitely know a lot more than you're letting on, but that is maybe an important thought that SR&ED of the ITCs are an entitlement written into law in the Income Tax Act, and you know, a little bit akin to, I say to folks, you would always expect your benefit back from the government when you contribute to your RSPs, and SR&ED is no different. If you are spending these funds and expenditures as per the Income Tax Act, you're entitled to this refund. So thanks for having us, and we're going to share about SR&ED and a little bit of a touch on the newer Clean Economy ITCs as well, but definitely a core focus on SR&ED with everyone here today. So some quick intros. I'll go first, and then I'll join back a little bit later to talk. But Curtis Griffith, Director of Business Development here at CoPoint. Been in the SR&ED space for about 5 years now, despite better judgment, and enjoy it. So I'll joined here by two of my colleagues. I'll let the experts in the room say hi and take over the steering wheel here.
Awesome. I guess I'll jump in next. Yeah, Peter Maitland. Thanks, Curtis. Director of Shred Tax here at CoPoint. I used to be called TSGI, and actually I've been with the crew for almost 20 years as of November, so been around forever. Article at Collinsboro, got my CA there back in the day, so I've been in Calgary for a while, and yeah, I really enjoy the shred world. Lots of gray areas, lots of uncertainty both in whether the project qualifies or not. Lots to get to deal with CRA, which actually is fun, believe it or not. And free time, a couple kids at home, and a couple pets, and also have done volunteer radio on CJSW here at the University of Calgary as a community member for the last 25 years. So that's kind of my hobby is tunes. But for more tunefulness, we'll pass it on to Graham.
Yeah, thanks, Peter. Really excited to be here. My name's Graham. I'm the Director of Science here at CoPoint. So I lead our small army of technical experts who have a wide range of backgrounds, including mechanical, chemical, biomedical engineering, life sciences, computer science. Myself, I have a Master's of Science from the University of Alberta and a PhD from the University of Calgary, where I studied intestinal inflammation. 3 young kids at home, which keep me tired and on my toes, but I'm excited to be here and talk about the SHRED program and discuss some of the main components of it.
Awesome. Thanks, Graham. So I'll hand it back to Peter to kick us off. But as Jimmy mentioned, just the goals here is, a little bit of a lay of the land and deep enough into the program financially and technically to give yourselves as leaders in your own businesses some ammunition to be dangerous and understand where could your clients be benefiting from these entitlements, as mentioned through the Income Tax Act. So we'll start out with a bit of a one-on-one finance that Peter will lead. Graham will jump in on some more technical and science eligibility things to keep an eye out for. And then I'll talk a little bit about the new Clean Economy investment tax credits to wrap up. Peter.
Awesome. Thanks, Curtis. And yes, important fact though too, before we get too far into these details, tonight's game, I'm from native Alberta, from Northern Alberta, but I'm a Flames fan, but I'm still going for Edmonton tonight. So we'll see how it goes.
We'll do a poll. Maybe we'll do a poll before the
who's on side or not. So, and I was going to say, I'd rather keep the pretty loose discussion. So any questions throughout the process, please interrupt. Happy to interrupt. I don't want to drone on for like 8 straight slides. There'd be lots of discussion otherwise. So even with my radio background, I can use some breaks on talking. So happy to answer questions. At the end of every slide, we'll offer an opportunity, but it's best if it's a fluid, interactive discussion. So pile on those questions. It's all good. So SHRED one-on-one is by far the biggest R&D incentive program in Canada at $4 billion from the feds annually, and some top-ups from various provinces. The only outlier is PEI, who does not have a R&D top-up. All the other 9 provinces and territories do have R&D credit programs that jump onto the federal program. We'll see more details in a bit. The more complicated programs, as you might expect, Quebec, Ontario, and Alberta. Those are 3 that always like some extra excitement in their programs. So some of the other provincial programs are more flat, say 10-15%, but there's some more nuances to the Alberta, Quebec, and Ontario R&D programs. And the nice thing about SHRED, it's not like a grant where you're competing against other people. If you meet the criteria, you qualify and you get the credits back, and we're here to help out with any sort of audit defense that happens with those credits. So you can file a claim, it can be accepted as filed, which is great news, and there's, the credits are awarded, or it can be reviewed. And even if it's reviewed, it can still be fully accepted, or it can be half accepted or 0 accepted. And then there's other avenues to try and fight back for some of those credits. The program is very flexible. We have clients anywhere from like 2 people companies to like 1,000 people companies. So it's any size of company, as long as you are doing some R&D work, available to all industries. And yeah, I guess on that note, any questions on that big picture information? So industries, maybe we'll have more questions once we get into like different industries. I'll just kind of cover like the high points: agriculture, manufacturing, energy, obviously in Alberta, some clean tech coming on board, and actually a real big growth area for the program throughout Canada is obviously software claims. So I know enough to be dangerous on the science side, but I've run the financial team, so definitely deferring to Graham and his great team on more details here. So let him jump in with some more color to these industries.
Yeah, thanks, Peter. So the SHRED program, of course, is an industrial innovation program, and it is important to note that it is industry agnostic. So it does support industries that touch all fields of science and technology. As long as you're really pushing the bounds of existing technology, there's a good chance that the work in R&D that you are doing is eligible for the SR&ED program. So some of the key industries are listed here, but it is important to note that these are really broad categories. So as an example, we have agriculture listed. That's diverse in and of itself. And we see clients that are producers themselves really aiming to, improve production on farm, or adjacent companies that are developing new technologies that really support data collection, automated technologies to improve production. And that's relevant for the other industries listed here. So manufacturing, IoT and automation, any sort of R&D that's looking to improve manufacturing processes, med tech and life sciences, that kind of all encompasses biotech, pharmaceutical industry, medical research. The energy industry, again, this can be oil and gas producers themselves really testing and designing novel completion strategies, development of new downhole tools, attempts at reducing emissions, clean technology, that can be carbon capture, hydrogen generation, storage, transportation, utilization, and of course, software and hardware, which is actually the largest component of where SR&ED claims exist within Canada. I think it's about 40% nationwide are in the software space. So really that's a really broad category, and it can be design of large scalable networked systems and applications, computational heavy workflows or platforms where performance or reliability is really constrained. So the broad take-home message is that the SR&ED program supports industrial innovation in all industries, and we'll get into the mechanics of the eligibility criteria later on, but it is an important point to keep in mind.
Yeah, I guess thanks, Graham. And one thing I've found from my experience too, like been almost 20 years here in the SR&ED world, and people always talk about, oh, is Alberta diverse enough? And I think slowly we're getting there. I think I've seen it as a proud native Albertan. We used to be a lot of oil and gas claims, which is still very important, but we used to be like 70-80% oil and gas related. Now we're probably about 50%. So just natural evolution of things in various industries. And oil and gas is still really important, but there's just some other industries that are also coming on board in Alberta. So it's exciting to see. And these are a couple of examples I have from more colorful examples from my travels. I was once involved in an audit of a medical marijuana company. This is before it was legal in Canada. So I remember going out to Kelowna for a review, and it was very much white lab coats, and you had to check into every room with your ID. Like, it was very strict given the times it was in. But that claim did qualify for SR&ED, and it was, they were doing things systematically and trying to learn things with medical marijuana. So there is examples of like various industries you might not think, even breweries, if they're doing new kinds of like beer that are uncertain if they're going to work or not, there is some potential for claims in interesting areas. It can't be humanities, but like various fields of science, it's broad. There's no limitation. So any questions at this point?
Yes, we do have some questions. Thank you. So one of the members asked, given it's a refundable tax credit, can you get SR&ED back even if you have losses?
For sure. And we'll have some details in a bit, but big picture, Jamie, is that we have, if you're a Canadian controlled private corporation and you have losses, then yeah, for sure. Then you can, if your loss company's never had any income, that money comes back as cash, which is great, obviously, both from the feds and the province. Where non-Canadian controlled private corporations, say public companies, they're, say a loss co, their federal is a credit that's not refundable. If you're either a bigger co, a public co, foreign owned, there's still potential for, say if you're a smaller version of those companies, get some Alberta cash back, because the Alberta is refundable. But there's some details coming up in terms of like when that's refundable versus not, or when you don't even get the Alberta one potentially, based on the size of the company.
And so if you were big enough that you don't qualify to get cash, would you have a certain number of years that you could potentially put it towards profit or taxable profit, or it's that year only?
No, it's actually like a non-capital loss pool. So you'd have carry back 3 years, and you'd have up to 20 years to use it. And say an acquisition, it'd also kind of be like a loss pool where if it's the same or similar type business that purchases you, still expectation of like revenue and income, then you should be able to utilize those tax attributes for a purchaser.
Perfect. So you might be getting to this after, and feel free to dismiss and we can keep going on. But you mentioned that software and hardware was the most common use of SR&ED, and I'm just wondering, like, if you're a company that's very tech enabled and working and experimenting with technology, both hardware and software, but you're not actually creating your own hardware and software, rather you're leveraging third party. How does that work, or is it just not applicable?
Yeah, no, that is a great question, and we do see that. Curtis is probably laughing. We do see that all the time. To kind of break it down into some more simple examples, if there is a technology that's simply leveraging third-party solutions or technologies, broadly, those types of implementations are not eligible. However, if there is integration of different third-party technologies or platforms or solutions into something that is being built internally, and that's leading to some sort of underlying issue or problem on the technical side of things, so maybe data reliability, scalability, any of those components, performance, certainly the integration of those types of tools may qualify, but the devil's always in the details in terms of what are the specific challenges that are encountered.
Okay, so if you're integrating two third parties, it's somewhere along the lines, it's got to be something you've created.
Yes, and we'll get into, well, a little bit. We'll get into the weeds a little bit more later on. So maybe we'll save that question for when we discuss technical eligibility. But certainly there has to be a moment where you encounter a failure, where you're looking at this and saying, broadly, we don't know how to integrate these different tools. We're running into problems, we're running into failures, and that's causing us to really go through an iterative development process. So really those key points of failures are the most important points to note for SR&ED purposes.
Okay, perfect. I have other questions here, but let's move on and I'll catch them after.
Awesome. Thanks so much. This next slide is a little meaty. This is kind of the crux of like what you can claim for expenditures. So there's kind of three core categories, I'd say: labor, contracts, materials, and overhead as a top up. So the first most common one, a lot of people do have, especially like that software example, those claims are more labor based. So any T forward salaries, you have to be Canadian employees. So you can't claim people that fortunately they're not Canadian or primarily working outside Canada. But if you have some people involved in R&D work in Canada, then you can claim a portion of their wages, either all of it. Actually, one nice thing about SR&ED is once you hit 90%, so say someone's 90% on R&D, the government allows you that 10% for admin and whatnot, so 90% becomes 100%, or ASA, all substantially all is the rules there. And obviously categories like testing, engineering, design, computer programming would be eligible labor categories, but for employees, it's a little more broad at times too. Like say if you have some shop employees doing testing or even fabrication of a new prototype, that time can be roped in as well as wages. Alternatively, say you hired someone as a contractor. So similar, a little more narrow to be honest in what they allow, like the same testing, engineering, computer programming, design, those categories all qualify still. But they're more strict. You don't maybe get the same kind of contractors doing, say, fabrication and things like that. That might slide into, say, the overhead bucket instead. One big difference, though, I always tell people, prospective clients, current clients, if you have an employee or an individual that is pretty heavy into R&D, like say 75% of their time or more, we encourage them to be employees rather than contractors. Obviously, there's a few more costs to having an employee. The big thing there, though, is save $100,000 of eligible individual dollars attached to SR&ED. For an employee, you get what's called this proxy bump, which is in the bottom right corner there, the proxy method for overhead. You get another 55%. So that 100,000 becomes 155,000. Where if you have a contractor, back in the notorious 2013 budget, I don't know if you guys remember that, I definitely do. There was a lot of things that changed, get rid of capital. They also added this haircut for contractors and third-party payments where they took out the profit element, air quotes here, and you only get 80%. So it's that same 100,000 for a contractor, you get 80,000 versus 155,000. So it's almost a 2-to-1 ratio. So someone that's heavier in R&D, like having them as an employee, even like a short-term or contract, like a 1-year employee or 2-year employee, that's beneficial versus having a contractor just giving those dollars. Again, if you're just like a one-off contractor, maybe they're like 10, 20% on the SR&ED side, then not as big of a deal, but the heavy R&D folks, best to have them as employees. And over the years, we convinced some clients to eventually get there after a few years, but you do leave a bit of money on the table when you have that structure with more contractors. So I'll skip to overhead. So the proxy method is driven off wages, where you might ask, well, what happens if you don't have any wages? That's when you have the traditional method. And the rules there is any traditional overhead costs, you have to handpick those costs. They have to be directly related and incremental to qualify. So with those, a good example is maybe there's no employee amounts, then yeah, I'll just try to find some traditional overhead that way. Incremental, maybe utility costs or things of that nature. The other option though is maybe there is wages, but then some of our big, say, oil and gas producer or other energy companies, there's a bunch of these big field trials. And you might have consultants out there in the field, but they're not, say, doing engineering or design or more of the science work. They're maybe just support and service workers. A lot of their time would go into that overhead bucket, traditional overhead. And those claims get quite large when you have some significant, say, AFEs or authorizations for expenditures. You can get nice buckets of cost for traditional overhead and those types of claims. So we see that there. The last category is materials. After this, we'll definitely pause some questions because there's a lot of meat on this bone of these eligible expenditures. Materials are one of the more gray, complex areas to claim in SR&ED. Because again, back in 2014 onward claims, they no longer allow capital expenditures. And then, well, you might say, well, what's capital versus materials? It often is gray. Is this a material for SR&ED or is it considered capital? One way I look at it and is kind of the rules say for materials, it's kind of like the core part of the experiment. Like say you're building a prototype, you're testing the body of the thing. Are these materials or components part of the body of the thing? Then you can likely argue it is materials. Where if it's more of a support piece of, say, test equipment that you can use on the project, but then a bunch of other projects, that would be viewed more as capital. So capital's out, materials are in. Just for the classification, there's two ways for materials. There's materials transformed, which have some value at the end of the fiscal year. Where, okay, they've got like 10% plus or 50% or whatever it is, there's still value for testing and other efforts. They'd be categorized as transformed. Whereas consumed is maybe you're developing something during the year, a bunch of things get scrapped and off to the boneyard, that's consumed. There's no value for those 10% or less, or just zero as of the end of the fiscal year. Or like say an oil and gas claim where you're pumping chemicals downhole, you're not going to recover, that would be considered materials consumed. So those are the four broad categories. Not to get too much in the weeds, but there's also for materials, the other complicating factor. Say you claim it as transformed one year, in a couple years, oh, it's working really well, and you sell the prototype, or it starts making you money. There is a recapture provision to pay back some of those ITCs based on what you're paid or fair market values. So there's some extra calcs there potentially. We do our best to try to avoid claiming materials that will be recaptured. And I'm not supposed to look at questions, but I see capital spend is not. Yeah, so no more capital from 2014, Jan 1, 2014 onwards, there's no capital. That's allowed to be claimed for SR&ED. But there has been actually, in the fall statement from the federal government, there was a proposal to put capital back in. But then obviously with some of the government changes, leadership changes, that's uncertain whether that will go or not. But there are some actually very lucrative potential changes for SR&ED based on that fall statement, which isn't law yet. It still has to kind of go through the process and see if that's going to happen. But this potential capital could come back. The other thing that attached to that is leases and rentals, because back 2013 and prior, you could also claim leases and rentals for SR&ED, but that's no longer currently eligible.
What
Grab some
about,
water.
on your slide, you said the word Canadian for employees, but did you mean literally Canadian or just that they're T4 employees that work in Canada, including if they're like a permanent resident or on a or sponsored employee or what have you?
I think those should be okay. Jamie, I think, yeah, like I just think more about like I say a US person that's maybe just US gets a US whatever W form or whatever, and then comes to Canada, does some work. But if they're Canadian based, either permanent resident or obviously a Canadian citizen, but if they get T4 and they're Canada based, I think we should be okay to claim as part of an employee category. Okay. But no, good question.
Yeah, I guess I know that some of the learning grants, literally they have to be Canadian, which is never feels fair or right. So I was just double checking on that one. Okay, and so the bucket seems to matter quite a bit then, because there's some complexities here, but you mentioned that if you spend 100,000 on an employee, then the proxy puts it up to 150.
Mm-hmm.
If it was a contractor, it gets scaled down or haircut to 80.
Yeah.
If something's classified as a material, it is included. If it's classified as capital, it currently is not.
Mm-hmm.
And is there a difference between like transformed or consumables in terms of like the benefit to you, or why does that matter?
That's a great question. No, that one, those are both just 100%. So say 100,000 of like materials, whether it's consumed or transformed, it would just be 100,000. I guess the one difference there is if it's consumed, you don't have to worry about recapture, but if it's transformed, you have to track it and say, well, if it still has value, is it eventually generating a bunch of revenue? Is it going to be sold at some point? So just it's more tracking for the transformed. But in terms of the original claim, it's the same 100% benefit.
Okay,
I
perfect.
just thought of something else too. For people often ask about, there's a little caveat for a bit of work outside Canada. So Canadian employees, say if you had called $1 million of Canadian-based shred work by employees, there is a rule that is allowed. You can claim up to 10% for Canadian employees doing testing and other work outside Canada. So say in that example, you could claim up to 100,000 of outside Canada wages. Say if someone goes down for trials or tests and has some time in the States, but once you're over that 10%, then that's where the cap is. But that's the only kind of exception. If it's any kind of, say you're working at a foreign university, like University of Minnesota or something like that, that would not qualify, unfortunately, even though they're doing eligible R&D work. The other thing though is sourcing materials. Like you can source materials, components anywhere in the world, as long as you end up in Canada and you're building that prototype in Canada and doing some testing and analysis in Canada, that's okay. And also maybe you develop something in Canada and it ships out across the border to be further tested, say in the States. Again, you should be able to claim those materials as long as it originated and you had some testing in Canada. There's a few nuances there about the cross-border type work.
Perfect. Thank you.
No, anytime. Any other questions?
Not yet. Let's move on. Thank you.
I'm almost done. Like that. I was actually want some of the more meaty slides. We're going to have some good science components here too, but on to, I guess, the most exciting stuff. So you have the big expenditure bucket, and it's like, well, what do you get back? So we'll have more detailed slides in a sec here, but the smaller private companies, Canadian controlled private corporations, CCPCs, 40 to 48% back in Alberta. So that's obviously great. So if you had a claim of $100,000 first time claimant, that's $48,000. And hopefully that's even bigger than that. Where the public, non-Canadian or larger companies, quite a gamut there, but 15 to 32% back. So any initial, well, maybe I'll go to the next slide and we get into the weeds for questions and stuff. Because this next one is all about Canadian control of private corporations and kind of their different rates and stuff like that. Okay, 48%, 40 to 48% back in Alberta. So first, looking at this chart here, up to $3 million, the federal government has a $3 million expenditure limit. So that's quite generous. Like if you had $3 million claimants, over $1 million of refundable shred credits. Once you're over 3 million, then it's an interesting category. We don't see it a lot, we see it sometimes. It becomes 15% non-refundable with an asterisk. It's actually for the CCPCs. Once, say if you had $4 million of expenditures for a CCPC, that 3 million is still the fully refundable. For that $1 million, you're at 15%. So then rather than getting 35%, you're at 150,000 is that incremental amount. And actually 40% of that is refundable versus 6% is a carry forward. So that's carry forward for either 20 years, you can carry it back potentially. But that's how the 15% works over 3 million, if that makes sense. So you'd have like a good chunk refunded, but then you'd have a little bit carry forward. The Alberta side, for first-time claimants, it should be 20%. If you've never claimed Alberta, it's called the Alberta IEG program. A little more complex. As of January 1st, 2021, that's when the new, it's basically Shred 2.0 came on board. 2009 to 2019 was 10% flat, a little more simple, but this has more upside and it's kind of, it's incenting people to increase their spend and you get bigger amounts. There's no, like 2020 sucked for a lot of reasons. Also, there's no Alberta Shred program. So with the pandemic, that was one little vacation from that. But 2021 onward, we've got the IEG program and it keeps people like us more employable because it's more complex. You have to, once that first year is over, okay, 20%, but then year two. So say if you had a $100,000 Alberta claim or 100,000 of expenditures in 2024, zero in 2023. For 2025, you have to look at the average of 2023 and 2024. So I'm doing some math on the fly here, see how it goes. For 2025, you look at an average of 50,000 is kind of your rate. So say if you had another $100,000 claim, 50,000 is just going to be 8%, and the other 50,000 is 20%. You get that bump up. But as you get to a certain point where you have maybe average of like just 100,000, the next one's 100,000, it's all 8% because it's always based on the prior 2 years of eligible expenditures, and it's eligible SR&ED expenditures for the associated group. So if you have a few companies doing SR&ED, it's combined. So you might have one big guy, one small guy. The small guy still only has 8% if there's some bigger claims in the past. So that's where there's 8 to 20%. The government math, the Alberta and other provincial programs reduce the federal. So that's why you're at, rather than say 43 to 55, you're at 40 to 48%. The other thing from this slide, we'll get some questions in a sec here too, because there might be some coming up, is the Alberta. So the federal, you have 3 million between like 35% and above that's 15%. For Alberta, you're at 4 million is the limit per year though. So that's pretty healthy. So say if you're at first time claim with a boatload of spending, that 4 million is actually becomes 800,000 cash. So that's pretty sweet. Where say if it was 8%, that's 320,000 for that 4 million. So that's the limit there. And yeah, we'll get into taxable capital a bit more on the next slide because that'll be more impactful then. But any questions at this point?
Yeah, so if you're in Alberta and you have this opportunity for the additional, does that apply to, you know, to your whole company's operations, even if some of it's not in Alberta, but you're an Alberta taxpaying organization and headquartered organization, or is it like end up getting split based on what's happening in Alberta versus what's happening somewhere else?
Jamie, that's a great question. We worked on a claim recently where it was like, you know, good sized oil and gas, kind of not a producer, but like doing some completion technology, and they have permanent establishment in BC and Alberta. So anything that's kind of BC for some employees, contractors, that is not part of the Alberta calculation. And actually the Alberta government does review claims. Like CR reviews claims about whether they qualify or not. So they could turn down the science, for example. Whereas Alberta just is really focused in their reviews as did it happen in Alberta? And if they find out it didn't, then they can give it a haircut. So no, it has to be Alberta based. I guess the one advantage is for that average 2 prior years of expenditures, that's Alberta based. If you had, say, some stuff outside the province that isn't part of that calculation, just in Alberta.
And so for many of our members, they'd be at organizations like the one you just gave as an example. Are the other provinces giving similar additional ITC opportunities?
I can give you some, if I remember, some quick ones here. BC is 10%. And again, it's kind of almost like the federal at 3 million. It's like CCPCs get refundable. If you're not a CCPC in BC, it's again a credit against BC taxes payable.
Okay.
Saskatchewan's also 10%. I'm pretty certain the limit for Saskatchewan's only 1 million though. So you'd have up to 100,000 of that. And I guess BC, if it's 3 million at 10 would be 300,000 of potential credit per year. And in Saskatchewan, once you're over that limit, it's again a credit. And I think there's some ins and outs there too. I'm pretty sure both BC and Saskatchewan provincial credits, you have 10 years to use them, not 20. So there's even ways you can renounce those provincial credits if you're not refundable to then get a bit more federal. You overall lose out in terms of like the total ITCs, but if you're not going to use them, then it just makes that federal a bit bigger and you have again the 20-year horizon versus 10 years. So there's some tax planning that can be done, and we look into that as part of our service. Okay, how do we optimize if you're not refundable? How can we optimize some of this these credits?
Great. So another member asked a question about does the current year apply for IEG reduce the current year claim for SR&ED, or is the IEG deducted the following year after approved?
Well, that's a good question too. I think it's, again, this keeps us employable. Different rules. The IEG and provincial are the same year. Well, a couple of different wrinkles. This is going to blow some minds here, but how it works is for the core expenditures, like say you got your wages, contracts, materials, traditional overhead, not proxy, but all those ones are part of what's called the SR&ED pool. That's always the same year it's incurred. The proxy portion of say provincial programs, if you're using a proxy, you have an option to use it the same year or to do it the next year. We generally just do the same year for simplicity and say, okay, provincial is all the same year. The federal is the next year, but it's the federal is utilized or refunded is the next year. Say if it's just a credit that's carried forward, you're not taxing that until the year after it's utilized. Whereas if it's refunded, then it's the next year you're taxing that. It's part of the SR&ED pool as well. So where we get involved, for Schedule 1 for tax, we're often reconciling that and doing extra calculations and adjustments, but we send our external accountant friends, they send us the draft return, with the original Schedule 1, we send back a reconciliation, say, here's our changes, here's the adjustments we've made, here's your revised either income or loss, and just make sure that's all understood. You also do some tax planning with the SR&ED pool itself. Different than ITCs, people get confused on this. SR&ED pool itself is actually pretty powerful, no expiry. So you start maximizing that SR&ED pool for a loss company, you don't have to worry about 20 years. So we try to maximize that. And for tax planning, that's the last thing you should start dipping into. Use your ITCs, use your losses, then the SR&ED pool is last. Again, an asset if you're purchased.
Excellent. Thank you.
No problem. I got one last slide here. Non-CCPCs. So a few different wrinkles here. Again, if not CCPC, no matter what, you're 15%. And unfortunately, that is fully non-refundable. It's not like over 3 million in the other example where you get 40% refundable, 60% not. All not refundable. But again, 3 years carried back, 20-year carry forward, or current year if you have taxes payable. I should mention too for the refundable, if you have taxable on your CCPC, the SR&ED credit goes first against your taxes payable and the remainder gets refunded. Or if you're really taxable, it just goes all against taxes payable. But again, it's a pretty powerful where it's concentrated against whatever your tax rates are in that tax payable number. So non-CCPCs, the easy ones are once you have prior taxable capital, and again, it's in associated groups, so Schedule 33, that is pretty important for SR&ED. The prior year, so say 2025 claim, 2024, 55 million taxable capital. At that point, no Alberta, you're out. And even for Canadian controlled private corporations, once you get to that size of prior taxable capital, that also wipes out the refundable Alberta and actually also takes you from 35% federal to 15% non-refundable. So I guess the big question is, well, for these folks again on non-CCPCs, pubcos, 4-node codes, etc. If you're $10 million or less of taxable capital, it's again easy. You're up to the 8 to 20% refundable Alberta amount for the IEG. So that's again decent, and you get some refundability there, some cash. Where it gets complex is between 10 and 50 million. Every dollar between those, you start eroding how much you get for the Alberta. So I'll do an example. See if you have 30 million of prior taxable capital. What's going to happen for your Alberta credit is you actually only get 50%. Say it's calculated as $50,000 for an Alberta credit. Because of that rule, you actually only get 25,000. And just like if it was 40 million rather than 50 million, you'd only get 1/4. If it's 20 million, you get 3/4. So you see the example as it kind of erodes over time. Also, with that $30 million example prior year, rather than having 3 million of SR&ED expenditures for federal, it's 1.5 million. Again, it impacts, but that's a bit more generous for the feds. It just impacts the total. So say if it's $1 million claim, you're still fine. In that Alberta example, once you're over 10 million, it starts eroding the percentage you get back in addition to that 8 to 20%. So again, there's some math gymnastics there to do. So beyond that, I think that's the main thing there. But any questions on that? Because that is a bit complex.
I don't have any questions on this one, but could you maybe give us an example just to help us illustrate it? That would help.
Yeah, I almost wish I had we sometimes have our summary has everything, but I can't show client ones. But like an example would be, let's go with again that same $30 million. I'll even have my calculator. That $30 million prior taxable capital. Say there's like a $500,000 SR&ED claim. It's all Alberta, but say it's a first time claimant. So you got like, okay, you got 20%. So you're at like 500,000 times 20% is 100,000. You have normally for that IEG credit. But if you have 30 million prior taxable capital, rather than 100,000, you get 50,000. Because once you have more than 10 million of prior taxable capital, it starts eroding what percentage you have for the IEG. So again, it's 50% for 30 million. If you're at 20 million taxable capital prior year, it's 75%. If you're at 40 million taxable capital, it's 25%. So that would go from 100,000 to 25,000. Once you hit 50 million, it's zero, unfortunately. And it's also on the federal side, the expenditure limit. You go from 3 million, 1.5 million. If it's 20 million, it's 2.25. If it's 40 million taxable capital, it's 750,000. But again, if your claim is 500,000, even that 750,000 example, you still get the full federal in that case. Just the Alberta that's really impacted for the IEG calculations.
And then if you were in other provinces, does it have similar like complexities and levels?
That's a good question. Not quite as complex as Alberta, but it would have,
So with more comes more complexity.
yeah, like once you're over 10, between 10 and 50 million is kind of, if you're over 50 million, it's easy, sadly less lucrative. It's just 15%. But between 10 and 50 million of prior taxable capital for the associated group of companies, that's where some extra math is involved.
Okay, excellent. Thank you.
And maybe Peter, I'll add more of a clarification. I get this a lot in early conversations. Like it is based on the previous year. It's not maybe clarify how that works. Like if the previous year taxable capital is fluctuating or the first year of business has stood up, exactly how that works. So it doesn't, because you hit that $50 million threshold one year, doesn't mean it stays with the business.
Yeah, it can change. You can go from 50 to 40 and whatnot. And that's a great point. Maybe you have a new oil and gas producer that started in the first year that's getting organized, so say 2023, maybe they have like 25 million taxable capital, then that impacts the 2024, then they're not 50 until it's the 2024 year, but that doesn't impact SR&ED until 2025. So you always have that year of grace. So first year claimant, first year of a company shouldn't be an issue because unless there's some big associated companies, you should be zero for taxable capital if it's the first year for that first claim. And I had something on my tongue otherwise, but I forgot it. So at this point, I've blabbed long enough, so we'll pass on to Graham for the important science he does. Because to be honest, all this great financial stuff doesn't mean anything unless the project qualifies. So step one is an eligible project. And once you get that, you start attaching dollars after that. So take it away, Graham.
Okay, thanks, Peter. I was going to say now on to the boring information. How to identify when work is eligible. So hopefully now that we've covered some of the more mechanics of the program, how it works, what the net returns are, I'll provide a little bit of a more in-depth overview of the eligibility criteria of the program and really how to identify when a program or when a project might qualify for SR&ED. It is important to highlight here that CRA does distinguish three main types of work that is eligible. It's not really important to identify which category your project might fall into, but it does provide good context as to what types of work CRA does see as eligible. So they do see basic research, applied research, and experimental development as all SR&ED eligible work. So basic research, you can think of that as more kind of research that's performed within universities, really fundamental research that's performed to advance science with no real practical application use case identified. There's applied research where research is performed to really advance scientific knowledge with a practical application. So here you can think of vaccine development or new drug development. And the third category is called experimental development. And this is actually where the vast majority of SR&ED claims exist within Canada. And this is work performed to advance technological understanding to develop new or improved materials, devices, products, or processes. So here, if you've developed an existing technology, but you're really seeking to improve it, or you're hoping to apply it in maybe an environment or an operating condition where it typically isn't deployed, and that's leading to failures, causing you to iterate on it to improve it. Even minor incremental improvements to existing technology may be eligible. So hopefully that provides a good context to the types of work that might be eligible. Getting into the details more granularly, CRA has tried to simplify how they're assessing projects and if they're eligible to the SR&ED program or not. And they'll really ask two key questions when they're assessing eligibility. They will ask, why are you doing the work and how you are doing the work? So I'll discuss each of these just to kind of break them down, and hopefully that allows you to potentially identify SR&ED eligible projects. So for that why component, CRA says work must be performed for advancing scientific knowledge or achieving a technological advancement. So I know that's a little hand wavy and hard to maybe really understand what they mean here, but really what the important point is that there is a need to develop or generate new conceptual knowledge that advances the understanding of science or technology. And so really new knowledge is needed when there's a gap in existing technologies or a gap in scientific or technological understanding that's preventing you from meeting your project goals. So really broadly speaking, when you're looking at a project and trying to understand if it's SR&ED eligible or not, focusing on that why criteria, really the important question that you need to be asking is the existing technology limited? how is it limited? How is it not suitable to meet my project goals? So really the key there is to identify what is the gap in knowledge and what is the limitation to existing technology that you're hoping to improve upon. Moving on to the how criteria, this one's a little bit easier to understand. CRA says that work must be a systematic investigation or search by means of experiment or analysis. But what that really means is that you're generally following the scientific method. So really crudely, you can even think back to high school science courses or that you may have taken. Really, you've identified a gap in existing knowledge or a limitation in existing technology that ties into the why component. And what you're doing to resolve or overcome that limitation or improve that technology follows a systematic methodology. So you've come up with a proposed solution or a hypothesis. You're performing testing of your proposed solution, collecting data, analyzing data, and hopefully coming to an answer on if you can overcome that gap or not, that gap in technology, or it's informing your next iteration. So you're going back, developing a new solution, and then again, going through that testing process itself. So really, you can think of it a little bit like following the scientific method, and you're developing proposed solutions to improve technology, testing that approach, collecting data, hoping to understand if you can really improve the technology as you go forward and iterate. It is important to note that for work to be eligible, you do not need to have a successful project. So we always say failure is a good thing for SR&ED purposes. That's obviously not a good thing for your business, but failures during the R&D process really indicate and highlights the presence of significant barriers to developing that technology. One of the things that we often do is we engage with clients and we navigate the audit process, as Peter mentioned before. So what that looks like is CRA has a technical reviewer from their side. They'll meet with the taxpayer and the claimants, and they'll discuss, okay, what technology you're hoping to develop, what work did you do throughout the year that you filed your SR&ED claim, and the guidance that we provide to our clients is always that you need to think of it like a reverse sales pitch. So we really tell clients to focus on what components of the project were the most risky, which components had the most failures, and really highlight that fundamental development process that that the team took in order to attempt to further the technology. So I know that was a really quick and dirty high-level overview of the eligibility criteria. So maybe I'll pause there to see if there's any questions.
Is it possible for you to give us an example of a client that you've worked with so that we can see it illustrated a bit?
Sure. Yeah, definitely. Maybe some of the ones that are a little bit more concretely able to understand are physical tools. So the example that I can provide is a company that's developing a new downhole tool that they're hoping to deploy in wells that are, much deeper depths, or the temperatures are a lot hotter, and they don't know how to overcome that. They've identified that some of the sealing arrangements or sealing components might fail at increased pressures or increased temperatures. So they go through design iterations, they use different types of seals, they look at different flow paths, the effect of pressures on the different components. And then when they ultimately test it, they encounter a failure, and then that goes back to their original design phase where they're coming up with new concepts, iterating on the design to hopefully overcome those specific failures. So that's one example, and maybe another one I can provide is maybe in the agriculture space. Somebody has developed a new genetically modified crop, and they're looking to understand how or if they can grow it in a unique environment. They understand that temperature fertigation strategies have a big effect on the overall growth, but the unknown that they're seeking to overcome is what strategies need to be used in order to optimize growth of that specific new novel crop. So they're going through a research program to really understand how or if they can really improve growth performance over time.
Excellent. So the examples that you've given, and in the earlier comments, failure was one of the things that made it easier to tell that you were doing applicable work. But what happens if, like in that first story, the first try got it right?
Yeah, so
That
that's
would be dreamy for so many reasons. You might not care about shred, but
yeah. Yeah, so those are always the more challenging conversations that we have to have with clients. Certainly, if you've clearly identified that yes, this project is risky, here's all the things that we were really concerned about. From a technology standpoint, it was very uncertain on if it was going to work or not. Just because it did work should not preclude you from claiming shred. Certainly makes it a lot easier if you did come up against a lot of failures. When we engage with CRA reviewers, that's typically the feedback that we get from them is they will say, okay, you're applying, broadly the industry knowledge that's available to you. When did you encounter a failure? And from CRA's perspective, they always try to indicate that you must have that failure point that marks the beginning of a shred project where you've kind of applied all of your know-how. And if you don't really meet that failure point, it's challenging to claim it for shred purposes, but certainly we run into situations where it is really clearly documented and demonstrated that yes, there is an uncertainty here. Just because your team was whip smart and solved the solution on the first crack doesn't mean that you are precluded from claiming it. But again, the devils are always in the details of understanding what the actual project is.
yeah, and I imagine you should just be happy that it worked, right? There's
Yeah.
just a point of that where it's like where it shouldn't be as harmful to not get the shred if you got that other amazing opportunity to get it right the first time.
Yeah, it's always a tricky situation because we're always meeting with clients and hoping to understand what did you do that was a complete failure or a complete flop. So we want to hear all the horror stories whenever we're meeting with clients to chat about their R&D work.
Perfect. Okay, thank you.
Okay, awesome. CRA does make a distinction between technology development and other business objectives or business uncertainties. So as you're thinking about shred eligible projects and what the overall scope of eligible expenditures are, it is important that CRA does make a distinction between technological uncertainty and efforts, expenditures that are related to the technology development process itself, and those that are more related to business uncertainty. So we have some of those listed here. Under the technical uncertainty, those may be a little bit more clear: engineering, computer programming, mathematical analysis, incremental testing, data collection that's really informing and furthering the research development project are shred eligible. On the flip side of it, if efforts are more related to resolving business uncertainty, CRA says that those expenditures are not allowable. So marketing, market research, style changes, UI changes, routine data collection, bug fixes, those things are not, they do not fall under the shred umbrella of eligible expenditures. So it is important to keep in mind that distinction, particularly for individuals that may have multiple job functions. They may be really intensely involved in running the business. They may be involved in marketing, but they also might be involved in the technology development. It is important to keep that in mind and hopefully kind of track and really well document when people are involved in performing R&D activities versus more business related activities. So yeah, I'll pause again there to see if there's any questions.
Yeah, I have a question. I don't know if this is the right time to ask it, but how do you, I guess, as a team interact with like grants? Because, there's grants and then there's shred, and they're not in any way the same, but sometimes they relate to similar activities. And, could you get a grant for something and then also get a shred? And like, how do you know which one to apply for? What's the intersection of grants and shred in your guys' world?
Yeah, so maybe I'll talk high level about because that's a nice segue into the next slide here, and I'll let Peter speak to some of the mechanics of how grants affect your shred claim. But certainly when we're looking at signs or clues if any project might be eligible, industrial innovation grants are one of those clues that we look at that indicate, okay, yes, you know, a company has received IRAP funding for this project. That's really indicative that, you know, another government agency has looked at this and said, yes, you know, we believe you're furthering technology. So that gives us a little bit of confidence that there might be SR&ED eligible project. And there are some other clues that we look at, including patents, publishable technical findings in scientific journals, technical conferences, if high-powered teams are involved, geologists, engineers, PhDs, and more critically, if there's really high rates of failure or cost overruns, that can be a really good indicator that there might be SR&ED eligible work there. So whenever we're engaging with a client or someone and we're looking to understand the project as a whole, and they say, you know what, we thought this project would cost $300,000 and we spent $1 million on it. We really like to focus our discussion on what went wrong, what caused those cost overruns, because that might really indicate that technology was failing and there was a really iterative development process that occurred. But maybe I'll pause there and I'll nudge Peter to chat a little bit more in depth about the interface of grants and SR&ED.
For sure. One of my favorite questions, because I always say for grants can be hard to get, but you can get them, go for them for sure. Don't worry about the SR&ED as much. You have to do some adjustments for any grant received, but it still be quite lucrative. Like the example is, say the same $100,000 spent on an employee. So you get that 55% proxy bump. So you have 100,000, and then say a grants agency gives you for those similar employees 75,000. I think, well, it's only 25,000. I only get the proxy on 25,000. That's actually not correct. You get the proxy still on 100,000, and then you take off the 75,000. So if you go 100,000, 55% proxy is 155. Take off 75 for the grant, you're still at 80 net. So you still have like 75,000 cash. It's the nice thing about grants is they're more, you know, proactive. So you get them as you're doing your work. Where SR&ED is after the fact, so they can play nicely together. Where you get the grant money as time goes along, and then you figure out, okay, what's the SR&ED portion after. I guess if the grants are if you have so many grants that the SR&ED is really reduced, then maybe it's not as worthwhile. But I always tell our clients, yeah, they can get grants. It'd be tough to come by. Go for them, and we can figure out how the SR&ED impact is. Especially if there's a lot of stuff you're claiming that isn't covered by grants, then the grants are just one piece of the calculation.
Awesome. Thank you.
No worries. Pass it back to Graham or Curtis here.
Yeah, I think that was it for me. So if there's no other questions, I think we can keep moving along.
For sure, GB. I think we kind of covered most of this stuff here. So we'll take maybe the last couple minutes, and I'll try and hit our timeline goal here and talk a little bit about the Clean Economy ITCs. So these new investment tax credits were actually went through the Senate this past summer. So if you haven't heard of them, they still have that new car smell on them. And it is something that is, in comparison to SR&ED, this is all fully refundable ITCs. So always cash back, irregardless, provided that it is a Canadian taxable corporation, irregardless of CCPC or non-CCPC status. This is refundable. There are 4 main categories. I think 2, which I've highlighted here, are going to be the core of the program. The Clean Technology ITC and the Clean Technology Manufacturing ITC, which I'll come back to. The Clean Hydrogen and the CCUS, or carbon capture and storage and usage and storage, are much larger scale projects. There is an NRCan application process. The project needs to be approved by NRCan and become a hydrogen or carbon capture eligible project. So think larger scale. Doesn't mean you can't apply for the smaller ones, but typically those are going to fall into those large, multi-billion-dollar projects that we all read about in the news. For the Clean Technology ITC and the Clean Tech Manufacturing, more, I think, small business or medium-sized business applicable cash refunds. So the Clean Tech ITC, up to a 30% refundable credit. The properties that we're looking at here, just think your solar equipment, wind equipment, battery equipment, some other non-road zero-emission vehicles, those kind of things. But looking at any kind of capital expenditure for these renewable energy products. And that starts, as far as qualification, anything purchased post, it was March 28th of 2023 for this Clean Technology ITC. So anything in that time frame moving forward, all the way to the planned expiry is in 2034. So up to a 30% refundable ITC on the capital expenditure for that equipment. the clean technology manufacturing. Think more as the name implies, machinery and equipment used for the manufacturing, processing of tools used in building clean technology. So, they reference maybe perhaps electric vehicle manufacturing, developing solar panels, wind energy, battery storage, anything that produces an outcome in that zero emission space. It's definitely worth looking at. And I'm going to pause there just because I know we're at time. If there are questions on these, we can go a little bit deeper there. But so a new program anticipated to be about a $98 billion program federally over the next 10 years. So as far as dollars and cents go, twice the size of the SR&ED program annually over the next 10 years for any business in Canada making these purchases as a cash refund.
Perfect. So we're at 1 o'clock. We're going to keep going for any last conversation and questions, but understand some people might have to jump off to get to their next meeting. If you do have any last questions, please do advise. Also, a reminder, Nikki posted the LinkedIn page as well as our AHA with Amplify sign up. So make sure that you're following our AHA, Amplify page on LinkedIn, and that you're also signed up as a member of AHA with Amplify. That's how you're going to get the slides from today, also the video from today if you want to share it with a colleague or business owner, what have you, and most importantly, the invites for our upcoming events when we reconvene in September, which will include webinars over the third Tuesday of the month, noon hour. So that will be September, October, and November with a break in December. And of course, live events to be determined, but those sell out. So you'll want to make sure that you're on the first come, first serve list. So back to the topic at hand. Quick question, as I posted on LinkedIn, I did my AI training. I started it this morning. And I know there's a ton of grants out there about AI, and obviously SR&ED would have something to do with AI. Can you explain to us how businesses that are exploring how AI can solve all kinds of problems, and most likely they are going to fail based on what I'm learning in my training, how are they going to be able to leverage SR&ED when it comes to AI? And what's the thought process there if you're about to start on integrating AI into your business? Is there things you should be thinking about documenting? I heard documentation a few times and how that can be the difference between getting a SR&ED claim and not. So what kinds of things should you be documenting and thinking as businesses start to bring AI into their processes and products and services?
Yeah, thanks. No, that is a really good question, and I think it's becoming more and more relevant as time proceeds here, and the technology as a whole and the AI machine learning space is developing so rapidly. So it's a little bit hard to keep up as to what is industry standard. But in terms of where AI machine learning can potentially interface with a SR&ED claim, we do see two major avenues of where it can be included. The first is a little bit more complex, where you're really attempting to achieve an advancement in AI machine learning itself. And some of the common themes that we see with our existing clients is really big concerns with data availability and data quality, and that's really affecting the output performance of models that you're hoping to integrate within your business. So really the big uncertainties that we see are more on the kind of data availability and reliability aspect of the technology itself. And the second aspect that we often see inclusion of work that's used integrating or leveraging machine learning algorithms or models is in this category of support work. So there's CRA has a category of eligible support work that may not be really driving technology on a fundamental level itself, but it's a little bit more routine in nature, but it is supporting an overall technology development. So you can think of just routine engineering, design, computer programming, data collection processes. So we do often see inclusion of clients that are attempting to leverage AI machine learning algorithms for a data analytics purpose in that support work category, in the sense that there may not be a lot of uncertainty in and of itself of how to use those tools, but you're really using the output analytics power of it to inform further technology development. So hopefully that was a clear answer.
Yeah, so one of the questions I have is like, obviously with the AI, if you're making a big change to a product or a service or a process, and you're coding or creating agents or whatever in order to do that, and meanwhile you're having some fail points, but at the same time, for most companies, they're going to be using third-party softwares and integration. So is that going to preclude them from having the shred opportunity? Or because they're doing actual coding and integrations, would it be applicable?
Yeah, and I feel like Curtis and Peter might hate me a little bit, but I always give the answer, it depends. So certainly if at a very high level, if the whole process is more of a routine implementation of a third-party solution, those types of projects are really challenging to successfully claim for shred purposes. If that is presented to a CRA reviewer, they typically say, you're leveraging an existing technology for its intended use case. You haven't really pushed the bounds and really furthered any sort of science or technology in and of itself. However, with the caveat, if you have to do those integrations to get a deeper understanding of a different technology or a different software platform, there may be opportunity to claim it. So again, the devil's always in the details, and I always give that wishy-washy answer of it depends. There's certainly opportunity, but at a very high level, if the project is mostly leveraging existing third-party solutions, those are typically challenging to claim for shred purposes, but certainly there's not zero opportunity there.
We have a member asking, does a company producing new technology that would be used in clean tech, like batteries, for example, do they qualify for the ITC program?
Yeah, maybe the same answer. They could. There's a very detailed definition of what qualifies for those. So at the surface, it sounds like that's worth maybe the 10 minutes of digging a little bit deeper, because it is at its core that clean tech manufacturing ITC is meant for, or is that equipment used ASA all or substantially all for the production of, and then there's 30 different kind of areas of, and think clean energy, solar panels, wind turbines, battery storage for electric zero emission use. So the answer is always maybe, without knowing the specifics, but yeah, that sounds like it's worth looking at for sure.
So if a member's at an organization and they think that shred could be applicable,
Yeah.
And they were to reach out to a company like yourselves for assistance, would it be better for them to talk before they start a project or after they've completed and failed and lost money on a project? That's question number one. And question number two is, how does the fee arrangement work? Because I think it is different than some other professional services, and it could drive people's decision as to whether to get the support or not.
Yeah, always yes to before the project or at the start of the project. So like anything in life, and maybe so much with shred, getting proactive, being disciplined about understanding what could be eligible, how to track the effort, the work, the iterations, the failures, all that documentation is incredibly useful in maximizing the outcome. Yes, it also becomes helpful if there's an audit, but in maximizing the outcome of eligible expenditures, for sure, we always want to be as proactive as possible before the project starts in earnest. And then, yeah, our business model and most in this space is 100% success fee based. So there's never a cash flow risk to the business. There's a percentage of the ITC amount that's billed on the actual acceptance or NOA from the CRA. So $0 of cost until there's a tangible benefit being distributed to the customer, to the corporation.
Yeah, thanks, Curtis. And also to clarify, Curtis has it absolutely right. Being proactive is always the right approach, but there is also an 18-month filing deadline past a company's fiscal year end to claim shred. So our company's stick handling a lot of companies that have a December 2023 filing period right now, and we have until the end of June to file those claims. So being proactive is great, but it's certainly worthwhile having a look back on potential projects that might be eligible, because there is an 18-month window past fiscal year end where you have the opportunity to file a SR&ED claim.
Yeah, thanks so much, Graham.
Here with us in June, so that's extra gratitude that you found
That's right.
time for us.
No, it's all good. And actually, that's a good point too, Graham, because it's like the fiscal year, or if there's a change of control or acquisition control or amalgamation or something changes and the year end changes and there's a stub, then for that stub period, we have to make sure where it's 18 minutes after the stub period. So you might have to say December year end normally, but say there's a stub that's June 30th, then the deadline isn't ended June in 18 months, it's ended December. So just being aware of like any stub periods and we can claim SR&ED on partial periods. Graham and I have been involved in like, say, a January to April claim. Then there's like a May to December for the rest. So 2 different claims. It's all in the tax period. It doesn't have to be 12 months. It's based on the taxation periods. The other good thing I think just had to tip my tongue is, there's something else kind of key with, I've lost it now, but there's a few other things. There's always different things to be aware of with SR&ED. Like stub periods are one, and there was something else, but maybe come to me in a sec as we chat more.
Yeah, no problem. So I think it's interesting because I wasn't anticipating another case for documentation, but if we think about the actual business nature of these projects and how critical documentation would be for you to advance for the next time you try an experiment and research and development, and for all the business reasons that documentation can be an advantage. And here's just another reason to make sure that you're tracking things and paying attention and being proactive and really leaning into communication, and in this case it being formal documentation. So I think that's, there's so many reasons why that makes sense, especially if you're taking big bets and big gambles.
Yeah.
And it's really good to have it reinforced from the angle of SR&ED. So I think that's a great thing that we can all take away from this as well.
Yeah, it doesn't have to be like perfect. It can just be like we've done some training, we do training for our clients, but I have examples in the past. We had a pretty good oil and gas claim, good sized one, where there's just a 1-page planning discussion about what they're trying to do and some of the technical aspects. And that got reviewed, and that helped save that claim. Okay, here was their intention. It wasn't just to get as much oil and gas revenue as possible. They had an intention on the science aspect, and that really helped that claim. Just 1 page. It doesn't have to be like a big novel, but documentation, various forms, doesn't have to be like pretty necessarily. You can have like various different, napkins and notebooks and whatever. So one thing that helps though is if it's contemporaneous, if it's kind of done as the project happens rather than after the fact. And the other thing I just remember I was thinking about, something else we help with our clients and their external accountants. We use 4 different kinds of tax software too. So ideally we're sharing the same software file, not like PDFs, we're having to re-enter stuff. So we're trying to share the same files so we can kind of make it more efficient for everybody that way as well. So we kind of have different methods to kind of make things easy. So we want to make things easy for our clients and also for their external accountants. We don't do year ends, we just do the SR&ED portion, and we combine our efforts with the year-end accountant and their T2 corporate tax return.
Yeah, and definitely on that documentation piece, that's one of the things that our team loves doing, is engaging with clients on a proactive basis to really improve their internal processes. But certainly we have gotten relatively creative in the past in terms of what documentation exists. As Peter mentioned, it comes in many forms. So we've even looked down to providing email evidence, email exchanges between technical folks that may outline questions. Really high level presentations that were maybe performed, many months ago that described the overall problem. So hopefully that doesn't scare anybody away. Documentation exists in many forms. There's certainly some best practices that can be implemented, but certainly there are many types of documentation that can be leaned on to really substantiate that, yes, this work did occur.
Excellent. All right. So the last thing we're going to do, unless there's some additional questions, is just ask each of you if you do have a fun story that you've seen where people were doing some exciting project or maybe got a major win when they did their SR&ED claim. So one last chance to tell a story, and then we'll wrap it up. Peter, do you got one?
I always got stories. I'll do one just very interesting again with that pandemic, where my last time on a plane for about a year and a half was early March 2020, and I was going out to Saskatchewan to see one of our new client signups that was new technology for harvesting hemp. and they're harvesting hemp and having to use different machines and stuff like that. So I went to a big agricultural site and saw their facility, which was pretty, it wasn't overly fancy, but that was a project that qualified, and they do some hemp harvesting and going to their site. I think we had the meeting after some guy's kitchen. This is all just pre-pandemic, where how these things that weeks later you wouldn't do, but just that was a really interesting example of like going to see this client and helping them out, and kind of again a different spin on things, ag with some hemp technology. So,
Yeah, and
example there. Thank you.
yeah, I think one of my favorite stories is we had one client who is he was a farmer, and so we went out to his operations. He was kind of in central Alberta. We had some initial phone conversations, and he identified, hey, I've got this one potential project. Why don't you guys come out? You can do a tour of the facility and really see the project as a whole. So did a little bit of a road trip out to central Alberta to see his farm. And as we're cruising around, he kind of nudged me and says, oh, hey, take a look at these fields I have over here. And I kind of looked over, and he had this huge operation where he essentially had an entire R&D operation that he was never going to tell us about. And he never thought it would qualify for SR&ED purposes. And of course, we kind of dug a little bit deeper and really kind of opened the door and opened his understanding in terms of, how broad the program is, what types of work it supports. So from my perspective, it's always fun to engage with clients and find those areas of their operations where they are, improving technologies, improving efficiencies, where, on first glance, they may think, that's just what we do. But really, on a fundamental level, it is eligible for the program. So
yeah, I'll add, it's great when there's a local client, a mechanical group, and they have a project, and they're going ahead with the project irregardless. So they believe in this idea, they want to, do their part, and it's all in a clean energy, renewable energy space. And you look at it, maybe there's a small claim at the front end, and they're so passionate, and you get through the work and you help them, and it turns into a substantial, size of a return for them. It is a meaningful, tangible, material amount of money for the business to help them pursue these goals. So it's always great. There's lots of folks looking for the money and trying to shoehorn projects into SR&ED, but always really energizing to find these folks who are pursuing these ideas irregardless, and it truly just helps them accelerate and fulfill those things faster. So that's those are always the fun ones.
Excellent. Well, I appreciate all of you coming out, and especially with the deadline pending, as you mentioned. We'll be sure to share the video and the slides with everybody. And thank you so much. Have a great day.
Thanks so much, everyone.
Thanks, everybody.
okay, thank you.
Take care.
Jamie.